Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, global markets reporter at Nasdaq. Joining us for this segment, we have Joyce, managing director on Nasdaq's market intelligence desk, for an update on technical levels to watch in the Nasdaq-100 as the index is officially in correction territory. However, the best performing index for 2023 on a relative basis. Brian, it's great to see you again. Welcome back to Trade Talks. And it's interesting, we are in correction territory for the Nasdaq-100. We're seeing what's happening with Magnificent 7 earnings and what investors are expecting with performance and guidance, but it's still the best performing index for the year.
No question. Even after the pullback from the highs in July, we're down about 12%, still up more than 30% year to date. So we're seeing the microcap index down 15%, the Russell 2000 down 10% year to date basis. And those two indices are deep into double-digit declines off the recent highs in July. So definitely holding up well on an absolute and relative basis.
Let's take a look at your first chart here, the Nasdaq-100, and then I also want to move along to the Magnificent 7 because we can see the impact that they're having to the index, especially with earnings. Investors want a beat and they want good guidance because there's some froth in those names.
Yeah, and what's important to note is how well the Nasdaq-100 has performed, and the sectors which is technology mainly, and the main stocks within technology that have been driving the outperformance and really holding up other indices as well, such as the S&P 500. And when we're seeing now some of those big names and those big industries starting to roll over, then that's the concern, because we were hoping it was going to be the opposite, that the other lagging, underperforming sectors, the value groups, would pick up their weight and their performance, and we're now seeing the opposite. We're seeing the pullback. So here's the Nasdaq-100. We're less than 2% below, I should say, from its 200-day moving average. So it's the only index that's trading above the 200-day moving average. The S&P, the Dow, the Russell 2000, all trading below the 200-day moving average. So I think from here, if we don't hold the 200-day, I think we can hopefully expect some support around this 13,600, 13,700 level in the Nasdaq-100. You mentioned the Magnificent 7. Here we are. This is the index. It's just breaking down today from this wide 1,400 point range. And so if we can expect or have a bias as to where it's going to go from here, we would think approximately 1,400 points down below this support level that's really been in place for the last 3 or 4 months.
Let's talk about the 10-year. That certainly has been a big story as everyone is focused on yields and the longer end of the curve here. Since the last FOMC meeting, and then we have another one next week, we've really seen quite a move.
Yeah, so the 10-year yield today is at 4.85%. Just earlier this morning, it was almost touching 5%. So this week we peaked at 5.025. Every week we seem to be trending higher and have been since July, and really, as you noted, since the last FOMC. If we want to look at the entire Treasury curve, the blue line here is the curve from the September 20th FOMC meeting, which was more hawkish than even the hawks were anticipating. And here's where the curve is today, which is the red line. And so the net change between those is the difference, or the movement in the curve. And you can see the longer maturities. Here's the 7, the 10, the 20, and the 30-year seeing much bigger gains. And as a result, you're seeing a re-steepening of the curve. And if we want to just plot, say, 2 of those, the 10s and 2s spread, we can see that has really begun to steepen quite a bit. It was at minus 77 bips the day of the last month's FOMC, and earlier this morning we were at minus 14 bips. So this has almost moved to positive territory, and typically when we do see that coming from deep inversion, that is typically a sign that a recession is imminent. Now, I do want to say that in prior, let's say over the last 30, 40 years, when that has happened, it's always been driven by the Fed cutting rates, which we call a bull steepener. This time, so far since the trend off the lows back in July, the steepening of the curve is being driven by the opposite. It's a bear steepener where the long end is rising higher than the short end. So it's not necessarily a recession indicator. Some argue that it's rising because the economy is performing better than expectations. And so we'll just have to wait and see how this plays out into the future and how economic activity comes in the future.
Let's talk about the U.S. dollar for a moment, because that has also had quite the move this year in 2023. I mean, it's great for us that are traveling overseas. However, it does have an impact to balance sheets, especially for these global conglomerates. Has it started to come in a bit? How is it related to the other parts of the market?
So the U.S. dollar, it has stopped its uptrend. Over the last 3 weeks, it's gone higher as well, but we could see this week's price pattern here. We're trading at the lower end of this week's range, which was very similar to, I should say this is a daily period chart, so that's today's price pattern. But we can see that it's stalling today at what's been a recent high. I'd call it a minor top but it put its high in last, let's say in the first week of October, October 3rd, and it's kind of been trading sideways, which is one of the things I guess that has surprised me a little bit, where we haven't seen the continued rise in the dollar, but we have seen equities continue to sell off, and I really think that's more of a function of what's happening in the rates curve.
Right, I would agree with you there too, but it seems, it's so interesting with this market, it's almost in this holding pattern, right? We have heightened geopolitics, we know we have higher interest rates for longer, everyone's focused on the Fed, everyone's focused on the quality of earnings beats or misses, as well as what's happening with the consumer. I mean, betting against the consumer hasn't been a winning bet, they just continue to perform, we saw that in the data this morning.
Yep.
And the market just seems to climb this wall of worry, and there are a number of factors out there, although I feel like the composure's a little bit different over the past couple of weeks, for good reason, and it's really in a holding pattern, not really establishing a direction one way or the other. Are the technicals indicating that, or what are they saying to you overall?
Well, here we're looking at the Russell 2000, and we can see that it's been, it's back at the lows that we've seen since 2022. So, we're seeing, the pullback, as we noted earlier, in the Magnificent Seven. We're seeing, breadth not getting better. So we're not seeing any bullish divergences in breadth. So breadth had been weak, all throughout this uptrend. We saw, expanding breadth a little bit in the late spring and the early summer, but it didn't last for long. And so we didn't get that expansion that we really needed to propel the market higher. So now we're seeing a lot of groups pulling back, and most recently those mega caps, those large caps, that Magnificent Seven group. And so, I think right now we're at a critical juncture here, in my opinion, because we're just seeing a break in those mega caps. We're now seeing the Russell 2000 testing what I think is a significant support level. It goes all the way back to November 2020, which was a price gap on the upside, which was in the very early stages of a historic 12-week move for that index. So, I think we're getting very close to where I think we want to see, this market hold in, and hopefully the seasonal trends that we typically see in the fourth quarter can kick in. But right now, we're not seeing much sign of that.
All right, Brian, appreciate the insight as always. Thanks for joining us on Trade Talks. And thanks for joining me. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.